Epam Systems experienced a sharp share price decline due to lowered revenue expectations for 2024. You can see right here from this stock chart that they were trading at about $307 per share, and at around the start of May, they plummeted all the way down to $181 per share in about one single trading day. Since then, they plummeted to a low of about $170 per share, which compared to their 5-year chart is one of the lowest share price records that they've put up in the last 5 years, as we can see right here. Even in mid 2022, they were as low as $198 per share. So they dropped even lower than that most recently at around the middle of June. But since then, they've climbed back up to $208 per share, and they might be able to climb back up to $300 per share, which would be a 50% increase from their current share price. We can also see that compared to the rest of the market year to date, Epam Systems is severely underperforming the rest of the market, which is up 16%. But if Epam Systems, like I said, is able to make a recovery, then that could be good returns for shareholders. There's also been an increase in the amount of shorts betting against Epam Systems, with bearish investors believing that ongoing pricing pressure and decreasing revenues will lead to the demise of this company. But that being said, Epam Systems currently has an average price target of about $270 per share, which highlights a potential upside for the stock of about 30% from its current share price. And if macroeconomic conditions improve, then Epam Systems could end up regaining the customers it lost due to the Russian invasion of Ukraine, as well as due to other geopolitical tensions. So as we can see right here from their financial statements, this is their income statement showing their revenue and earnings results for the first quarter of 2024 compared to 2023. And we can see that revenue decreased by 4% from 1.210 billion to 1.165 billion. We can also see that net income increased about 14% from 102 million to $116 million. So even though their revenue decreased slightly, their earnings ended up increasing. So that's obviously a good sign for shareholders, although ideally you would want to see revenue and earnings increasing. But if they can continue to build their profitability, then the decline in the share price might, in hindsight, end up being an overreaction if the share price is able to recover to $300 per share, or even better, to its all-time highs of around $700 per share, which would be a pretty massive return for shareholders. Then if we go to page 8 here, we can see their balance sheet as of March 31st, 2024. They had total assets of about $4.3 billion, and we can also see that most of their business was financed by equity, with $3.4 billion of equity and only about $900 million of total liabilities. So again, the company is also not leveraged that heavily, so they don't have financial debt obligations that they're going to have to uphold in the case of pricing pressure or decreasing revenues on their business, which is a good sign for their long-term solvency. But unfortunately, we can see from their equity section right here, retained earnings decreased slightly from 2.5 billion to 2.49 billion, and we can see additional paid-in capital unfortunately increased from about 1.008 billion to 1.039 billion. And the reason why that is not very good news is because additional paid-in capital increasing suggests that the company has had to issue more shares of common stock in order to raise capital to finance their business. But if they issue more shares, they end up diluting current shareholders, which decreases the share price of their common stock. On top of that, their retained earnings also decreased. You typically want to see additional paid-in capital decrease and retained earnings increase, because it means that the company is adding cash flows to their balance sheet while reducing the amount of shares outstanding, thus increasing the share price. But this combination of decreasing retained earnings and increasing additional paid-in capital ends up contributing to a declining share price, as we can see right here for Epam Systems. Now I want to look at this discounted cash flow model to look at Epam Systems' intrinsic value per share. We can see that their free cash flow in 2019 was about 190 million. And in 2023, sorry, this is supposed to say 2023, it was about 0 point, or actually it is 2022, I think. It was about 0.534, so 530 million. So during that period, their historic growth rate was about 30%, which I used for their free cash flow growth in the DCF model. And then also for their weighted average cost of capital, I calculated that using this calculator right here, which you can take a better look at. And so with that information, we can see the intrinsic value per share comes out to about $360 per share, which compared to their current share price means that Epam Systems is definitely undervalued. They're basically valued at around the same share price they were at in March of 2024. So if they are able to return back to that share price, then that would be, again, like I said before, a huge return for shareholders. Compared to other companies in their industry like Accenture and IBM, Epam Systems profitability is a little questionable. We can see that they have worse profitability than Accenture and IBM at 28% compared to 32% and 54%, and 8% compared to 10% and 12%. Also, they're the only company out of the three that doesn't pay a dividend, whereas Accenture has a dividend yield of 1.38% and IBM has a dividend yield of 4.05%. Basically meaning that for every $100 you invest into IBM, you're getting paid $4.05 in dividends per year. So based on this, it looks like IBM is probably the most impressive company just looking at the profit margins. Lastly, I wanted to compare Epam Systems to other companies we've looked at. We can see that based on intrinsic value per share, they're trading at 58% of their estimated intrinsic value. Compared to other companies, that puts them in about 5th place. Sorry for these like black streaks that show up on the screen. Not sure why that's happening. It's a bit glitchy, my Microsoft Excel, but I'll fix that by next video. We can also see Epam Systems growth rate. They come in 7th place at 29%, and they don't pay a dividend, so they don't make it onto the dividend yield table. Then we can also see that for profitability, Epam Systems profitability was not good enough to get them onto this table, but you can see the companies that were the most profitable. And then in terms of Q1 year-over-year revenue and earnings growth, Epam Systems had negative 4% revenue growth and positive 14% earnings growth, putting them in 5th place on the earnings growth table. We can see the companies mainly NVIDIA and Supermicro, as well as Broadcom, Kurasushi, Eli Lilly, Google, the known culprits of really impressive revenue and earnings growth that showed up at the top of the table. Lastly, I wanted to look at stock performance over the last 5 years. Epam Systems is up 7%. So basically they're breaking even over the last 5 years. They did have very impressive returns all the way through 2021. And then the Russia invasion of Ukraine happened. And a lot of Epam Systems logistics were located in Ukraine and Belarus, which was invaded by Russia. So as a result, their stock plummeted and they haven't really recovered since. But if they are able to divest their capital investments out of those countries and then move them to America or other countries, then it's possible that their share price might be able to return to previous levels. But for now, they have a 7% return over the last 5 years, not good enough to get them onto this table. NVIDIA had the highest at 3,400%. So let me know in the comment section down below what you guys think of Epam Systems. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.